In India, the economy is growing fast, but that growth comes with many hidden traps for the unwary. We are living in an era of unprecedented digital change and economic shifts across the globe. Welcome to the Munger mindset in the year 2026. To protect your wealth from loss, you must adopt a mindset that is both ancient and modern. This script will guide you through the core principles of the legendary Charlie Munger. We will specifically look at how his wisdom applies to the vibrant and complex market of India. The first pillar of our journey is the concept of extreme patience in an impatient world. Most investors today are chasing quick wins and following the latest viral trends on social media. They fail because they do not have a foundation built on logic and historical understanding. Charlie Munger always told us that the big money is not in the buying or the selling. The big money is in the waiting, because time is the greatest friend of a productive business. You must learn to see through the hype and focus on the underlying value of your choices. Managing your finances in 2026 requires a total elimination of unnecessary leaks. A leak is any expense or investment that does not align with your long-term goals for success. Think of your financial life as a large bucket that you are trying to fill with water. It does not matter how much water you pour in if the bottom of the bucket is full of holes. Most people spend their entire lives trying to pour more water instead of fixing the holes. Charlie Munger would say that the best way to get rich is to stay rational and stay humble. He often spoke about the importance of being a learning machine every single day of your life. If you go to bed a little bit wiser than when you woke up, you've already won the day. This is especially true in India, where the rules of the market are constantly being rewritten. New technologies like artificial intelligence have changed the way we earn and spend money. However, the basic laws of human psychology and greed have stayed exactly the same for centuries. By understanding these laws, you can avoid the mistakes that lead to permanent loss of capital. Munger believed that you should only invest in things that you can explain to a 6-year-old child. If the business model is too complex for a simple explanation, then you should walk away immediately. Complexity is often used by dishonest people to hide the risks and the fees of a bad product. In the Indian financial sector, you will find many people promising high returns with low risk. You must remember the golden rule that there is no such thing as a free lunch in this universe. Every high return comes with a corresponding risk that you must be willing and able to carry. If you cannot afford the risk, then you have no business chasing the return in the first place. The second pillar of our strategy is the concept of inversion, which Munger mastered so well. Instead of trying to be smart, you should focus all your energy on not being completely stupid. It is remarkable how much long-term advantage people like us have gotten by staying sane. In 2026, many people are losing money because they're trying to be too clever. They use complex algorithms and high leverage to try and beat the market in the short term. This behavior is like trying to cross a deep river because the average depth is only 4 feet. You will likely drown in the parts where the river is much deeper than the average suggests. To avoid financial loss in India, you must look for the deep parts of the market and stay away. Focus on the simple businesses that provide essential services to the growing middle class. These are the companies that have a wide moat and a strong competitive advantage over others. A moat is something that protects a business from the attacks of its competitors over time. It could be a powerful brand or a unique distribution network or a low cost of production. In the context of the Indian market, a moat is often found in companies that trust their customers. Trust is a very hard thing to build, but it is even harder for a competitor to take away. If you own shares in a trusted company, you are participating in the long-term growth of India. You are not just gambling on a stock price, but you are owning a piece of a productive engine. Charlie Munger always preferred to own a great business at a fair price than a fair business at a great price. This distinction is the difference between a successful life and a life of constant worry. When you own a great business, The passage of time is working for you instead of against you. The compound interest will start to work its magic and your wealth will grow exponentially. Compound interest is the eighth wonder of the world, and you must never interrupt it needlessly. Most people interrupt their compounding because they get scared during a temporary market dip. They sell their quality assets at a loss and miss out on the recovery that always follows. To be a successful investor in 2026, you must have the stomach to handle volatility. Volatility is not the same thing as risk, even though many experts will tell you that it is. Risk is the possibility of permanent loss, while volatility is just the natural movement of prices. If you own a house, you do not check the price every single day to see if you are still rich. You should treat your stock investments and your business ventures with the same long-term view. The Indian market will have many ups and downs as it moves toward becoming a global power. You must be prepared to stay the course and keep your emotions under strict control at all times. Munger was a master of emotional control, and he never let fear or greed dictate his actions. He looked at the facts and the numbers, and he made his decisions based on cold, hard logic. This is the only way to survive in a world that is becoming increasingly driven by noise. You are being bombarded with information from every direction, and most of it is completely useless. Your job is to filter out the noise and find the few signals that actually matter for your future. A signal is a piece of information that changes your understanding of the world in a meaningful way. Most news headlines are designed to provoke an emotional response rather than to inform you. They want you to be afraid or they want you to be excited so that you will click on their links. Do not let these digital distractions pull you away from your plan for financial independence. Your plan should be simple, and it should be based on your own unique needs and circumstances. There is no one-size-fits-all solution for money management in the year 2026. What works for a young professional in Mumbai might not work for a retiree in a small village. However, the principles of frugality and wise investing are universal across all boundaries. You must live below your means if you ever want to achieve true freedom from the rat race. Spending money to impress people you do not like is a fast track to financial destruction. Munger lived in the same house for many decades, despite being one of the richest men on earth. He understood that true wealth is not about showing off, but about having the power to say no. When you have enough money, you can say no to a job you hate or a boss you do not respect. This is the ultimate luxury that money can buy, and it is worth more than any fancy car or watch. In India, the pressure to show off wealth can be very high due to social and family expectations. You must be strong enough to resist this pressure and stay focused on your long-term security. Teach your family about the value of money and the importance of delayed gratification. If you can teach your children to wait for what they want, they will be successful in any career. Delayed gratification is the most important predictor of success in almost every area of life. This applies to your investment portfolio just as much as it applies to your personal habits. Avoid the temptation to spend your dividends or your profits on temporary pleasures today. Reinvest those funds so that they can continue to grow and create even more wealth for tomorrow. The path to 10,000 words of wisdom begins with these simple but profound realizations. We are just getting started on this journey of financial discovery and mental models. Let us look deeper into the specific ways you can apply these rules to your bank account. The third pillar of our financial fortress is the mastery of mental models for daily life. Charlie Munger often said that you cannot really know anything if you just remember isolated facts. If the facts do not hang together on a lattice of theory, you do not have them in a usable form. You must have models in your head, and you must array your experience on this lattice of models. In the year 2026, the Indian economy has become a complex web of digital systems. To avoid losing your hard-earned money, you need to understand the model of social proof. Social proof is the tendency of human beings to think and act like the people around them. When everyone in India is talking about a new stock or a digital asset, the pressure to join is high. You see your neighbors and friends making quick profits, and you feel like you are being left behind. This is exactly when the risk of a massive financial loss is at its highest point for you. Munger warned us that following the herd is a sure way to regressing toward the mean or worse. You must have the courage to stand alone when the data tells you that the crowd is being irrational. In 2026, many Indian investors are being led into traps by online influencers. These people use the power of social proof to sell products that only benefit the person selling them. To protect your wealth, you must use the model of first principles, thinking at all times. Break every financial decision down to its most basic truths and build your logic from there. Ask yourself why this company exists and how it actually creates value for its customers in India. If the value is not clear and the growth is based on hype, then you are looking at a bubble. Bubbles are beautiful to look at, but they always end in a painful pop for those holding the bag. The next model we must discuss is the power of incentives in shaping human behavior. Charlie Munger famously said that you should never ever think about something else when you should be thinking about the power of incentives. In the Indian financial system of 2026, incentives are often hidden behind complex apps. The companies that offer you free trading are making money by selling your data or your order flow. Nothing is truly free in the world of high finance, and someone is always paying the bill. If you cannot identify who is paying the bill, then it is very likely that the person is you. By understanding the incentives of the banks and the brokers, you can navigate their traps safely. Always look for the conflict of interest in any financial advice that you receive from others. If an advisor gets a commission for selling you a specific fund, their advice is naturally biased. A true Munger disciple seeks out independent sources of information and does their own research. In India, the rise of digital banking has made it easier to move money, but also easier to lose it. Cybersecurity is a major concern in 2026, and it is a significant source of loss. To prevent leakage, you must treat your digital security with the same seriousness as a physical vault. Use strong passwords and two-factor authentication for every single account that you own. Never share your private keys or your personal identification numbers with anyone under any pretext. Scammers in India have become very sophisticated, using artificial intelligence to mimic voices. They may call you pretending to be a bank official or even a family member in urgent need. You must apply the Munger rule of extreme skepticism to every unexpected request for money. Verify everything twice and never act out of a sense of urgency or emotional panic. Panic is the enemy of rational thought, and it leads to the biggest mistakes in money management. When you feel the urge to act quickly, take a deep breath and wait for at least 24 hours. Most financial emergencies are not as urgent as they first appear to be in the heat of the moment. The fourth pillar of our strategy is the concept of the margin of safety in every investment. This means buying an asset for much less than it is actually worth in the long run. If you think a business in India is worth 100 rupees, you should try to buy it for 70. That 30 rupee gap is your margin of safety, which protects you if your analysis is slightly wrong. In 2026, the market is often overpriced because of the high demand for Indian assets. This requires you to be even more disciplined and wait for the moments when the market crashes. Munger and Buffett spent years sitting on piles of cash waiting for a true bargain to appear. They did not feel the need to be busy every day, because being busy does not equal being profitable. In fact, most of the best things in life and in investing come from doing nothing for long periods. This is a very difficult lesson for the modern mind, which is addicted to constant stimulation. You must train yourself to find joy in the silence and the waiting of a long-term strategy. The Indian landscape offers incredible opportunities in sectors like renewable energy and technology. However, you must not overpay for these opportunities just because the future looks bright. A great company can be a terrible investment if you pay a price that assumes perfection forever. Nothing in this world is perfect, and there will always be bumps in the road for every business. When you have a margin of safety, you can sleep soundly during the inevitable storms of the economy. You know that your principal is protected and that you have a high probability of a good return. Preventing financial loss is not just about the math, but it is also about your own temperament. Munger believed that temperament is more important than raw intelligence in the world of money. Many high IQ people fail because they are too emotional or too arrogant to admit their mistakes. A humble person with an average IQ can outperform a genius by simply avoiding big errors. In 2026, you must be willing to change your mind when the facts change around you. The Indian economy is evolving, and what worked 10 years ago may not work 10 years from now. Stay curious and keep updating your mental models to reflect the reality of the current world. This constant learning is what keeps your mind sharp and your bank account growing steadily. We have now covered several key models, including social proof and incentives and margin of safety. Each of these is a tool in your belt to build a secure financial future for yourself and your family. The next part of our journey will focus on the specific traps of the Indian tax and legal system. Understanding these details is essential to stopping the leakage of your wealth through fees. We will also look at how to build a portfolio that can withstand the global shocks of the future. The year 2026 is full of promise for those who are prepared to think like Munger. Let us continue this deep dive and master the art of worldly wisdom together for your success. The fifth pillar of our financial defense is understanding the psychology of human misjudgment. Charlie Munger identified several psychological tendencies that lead people to make bad choices. One of the most dangerous tendencies in 2026 is the over-optimism bias. In a growing economy like India, it is very easy to believe that the good times will never end. People start to take on too much debt because they assume their income will always increase. They buy expensive homes and cars in cities like Bangalore or Delhi using high-interest loans. When the economy slows down or a personal crisis hits, these people find themselves in deep trouble. Munger warned that being overly optimistic is a form of self-deception that leads to ruin. You must always keep a realistic view of the future and prepare for the worst possible outcomes. This means maintaining an emergency fund that can cover your expenses for at least 1 year. In the Indian context of 2026, job markets can be volatile due to automation. Having a cash cushion is not just about money, but it is about maintaining your mental peace. Another psychological trap is the tendency to avoid pain by ignoring bad news about your money. Munger called this the denial tendency, and it is a major cause of financial leakage today. When an investment starts to perform poorly, many people simply stop looking at their accounts. They hope that if they ignore the problem, it will somehow fix itself over time without action. A rational investor in the Munger style faces the reality of a loss immediately and clearly. If a business you own has lost its competitive advantage, you must be willing to sell it now. Do not throw good money after bad money, just because you are afraid to admit you were wrong. Pride is an expensive emotion that has no place in a professional financial strategy for 2026. The third psychological trap is the influence of authority figures in the Indian media. We are programmed to follow the advice of people who look and sound like they are experts. In 2026, many talking heads on television are paid to promote certain agendas. They use complex language and professional charts to make their predictions seem very certain. You must remember that no one can predict the short-term movement of the Indian stock market. Charlie Munger always said that he did not spend a single minute trying to forecast the macroeconomy. He focused his energy on understanding individual businesses and their long-term prospects. If the experts on the news really knew the future, they would be billionaires, not television hosts. Be skeptical of any expert who claims to have a secret formula for wealth in the new year. The sixth pillar of our strategy is the concept of the Pavlovian association in your spending. Advertisers in India are masters at making you associate their products with happiness and status. They want you to feel that buying a certain brand will make you part of a successful elite group. This is a powerful psychological trick that leads to massive leakage in your monthly budget. You must break the link between your self-worth and the things that you choose to consume. A truly wealthy person is defined by what they keep and not by what they show to the world. Munger often pointed out that the best things in life are actually very cheap or even free. Reading a great book or spending time with your family costs almost nothing in 2026. Yet these activities provide more lasting satisfaction than any luxury purchase ever could. By focusing on low-cost, high-value activities, you can save a large portion of your income. This saved money can then be put to work in the Indian economy to build your future empire. The seventh pillar is the understanding of the envy and jealousy tendency in social circles. Envy is a very stupid sin because it is the only one that does not provide any fun at all. In the age of social media, envy is being triggered every time you scroll through your feed. You see your peers traveling to exotic locations or buying the latest gadgets in Mumbai. This creates a subconscious desire to keep up with them even if you cannot afford it. Munger believed that envy is a major driver of human misery and financial destruction. You must learn to be happy with your own progress and ignore the noise of other people's lives. Focus on your own financial goals and your own circle of competence without looking sideways. Your only real competition is the person you were yesterday, and not the people on your screen. In 2026, the Indian tax system has become more efficient, but also more complex. You must use the model of tax efficiency to prevent the legal leakage of your hard-earned wealth. Understand the different tax slabs and the benefits offered for long-term digital investments. A small saving in taxes every year can compound into a very large sum over several decades. Munger and Buffett always sought out investments that were tax efficient for their company. They preferred to hold stocks for many years so they would not have to pay capital gains taxes. This simple strategy allowed their wealth to grow much faster than if they were active traders. Apply this same logic to your own portfolio in the Indian market during 2026. Think in terms of decades rather than weeks or months to get the best results for your family. The final part of this section is the concept of the Lollapalooza effect in your psychology. This happens when multiple psychological tendencies work together to drive you toward a goal. It can be a force for great good, or it can lead to a total financial catastrophe for you. When greed and envy and social proof all hit you at the same time, you will act irrationally. You must learn to recognize when these forces are pulling you toward a dangerous choice. Stop and think about which mental models are being triggered by the situation you are in. By naming the psychological traps, you can strip them of their power over your bank account. This is the essence of the Munger philosophy for managing money without any loss or fear. We will continue to build on these ideas as we move into the next part of our long script. The eighth pillar of our financial strategy is the art of selection in the Indian market. In 2026, the number of investment options can be overwhelming for any person. You have thousands of stocks and mutual funds and digital assets screaming for your attention. Charlie Munger taught us that you do not need to own many things to be very successful. He believed in a concentrated portfolio of high-quality businesses that you know very well. In India, this means focusing on the sectors that form the backbone of the national economy. Look for companies that provide electricity or clean water or essential digital infrastructure. These are the businesses that will continue to thrive regardless of the global political climate. When you find a great business in India, you should buy as much as you can afford to lose. This may sound contradictory, but it is the essence of calculating your risk versus reward. If the odds are heavily in your favor, you should bet big and then sit on your hands for years. Most people diversify too much because they are afraid of being wrong about one single stock. Munger called this diversification because it leads to average results and higher management fees. If you have 10 excellent businesses, you are much safer than having 100 average ones. The year 2026 rewards the specialist who understands the nuances of the local market. The ninth pillar is the constant search for the truth, even when it is very uncomfortable to hear. You must be your own toughest critic when it comes to your financial habits and your choices. If you are spending too much on luxury coffee or expensive clothes, you must admit it today. Self-honesty is the foundation of all wealth because you cannot fix a problem you do not see. Charlie Munger was famous for his blunt honesty and his ability to cut through all the nonsense. He did not care about being popular or being liked by the crowd in the financial industry. He only cared about being right and being rational in a world that is often very insane. You should adopt this same attitude when you look at your bank statements and your bills. Stop making excuses for why you are not saving as much as you plan to save this year. The Indian economy in 2026 is full of opportunities for those who are disciplined. But these opportunities will pass you by if you are distracted by the glitter of the moment. The final pillar is the importance of a life well lived beyond the accumulation of paper money. Wealth is a tool that should be used to provide security and comfort for those you love. It should not be a scorecard that you use to feel superior to your neighbors or friends. Munger remained a simple man with a sharp mind until the very end of his long and amazing life. He found joy in sharing his wisdom and helping others avoid the many pitfalls of existence. As we look toward the rest of 2026, let us carry his spirit of rationality with us. By following these principles, you will not only prevent loss, but you will build a legacy of wisdom and strength that will benefit your children and their children as well. This concludes our deep analysis of managing money in India using the Munger philosophy. Thank you for spending your valuable time with us today to learn these life-changing rules. We hope this deep dive into the mind of Charlie Munger has given you clarity and confidence. Managing your finances in 2026 does not have to be a source of constant stress. When you have the right mental models, you can navigate any storm with a calm and steady heart. If you found value in this analysis and want to continue your journey toward financial mastery, please take a moment to subscribe to our YouTube channel right now for more deep insights. Your support allows us to create more high-quality content to help you grow your wealth safely. Do not forget to hit the notification bell so you never miss a lesson on worldly wisdom. Share this video with your friends and family in India who want to protect their future today. We are dedicated to bringing you the best strategies for the year 2026 and beyond. Thank you for watching, and remember to stay rational and stay curious every single day. Goodbye for now, and we will see you in the next video on our journey to financial freedom.